There's something strange happening in the UK rental market right now. Rents are climbing to levels nobody's seen before. Tenants are queuing round the block just to view a one-bedroom flat. Yet, at the same time, landlords are selling up faster than at any point in recent history. In the first 3 months of 2025 alone, roughly 18,000 rental properties vanished from the market. Not damaged, not demolished, just gone. So what's going on? Why are landlords abandoning ship when demand's never been higher? And more importantly, what does this mean for anyone trying to rent or anyone still holding property? Stick around, because the numbers tell a story most people aren't seeing yet. If you want to stay ahead of the latest UK property and housing news, hit that like button and subscribe now so you don't miss what's coming next. Let's start with the numbers that nobody's talking about. In January, February, and March of this year, something unprecedented happened. More than 15% of every property listed for sale in England used to be a rental. That's the highest figure on record. We're talking about roughly 40,000 former rentals hitting the market in just 1 quarter. Now, you might think, well, someone else buys them and rents them out again. Problem solved. Except that's not what's happening. Only 3% of those sold properties came back onto the rental market. The rest, bought by first-time buyers, owner-occupiers, people who wanted somewhere to live, not somewhere to let. The maths is brutal. Around 18,000 rental homes disappeared in 3 months. Meanwhile, the number of properties actually available to rent across the entire UK hit an all-time low. Just 284,000. That's 23% lower than before the pandemic. And it's not getting better. New rental listings fell by 1% compared to the year before. Supply is shrinking while the population's grown by more than 2 million people since 2015. It's like musical chairs, except every month someone's removing more seats from the game. The result? Every single rental property now attracts an average of 19 applicants. Some areas see queues of 30 or 40 people at viewings. Rents have climbed 30 to 40% in just 5 years. Yet landlords are still leaving. So why are they getting out? Let's talk about what's actually pushing people to sell. First, there's the money. Mortgage rates shot above 5% during 2023. Even though they've dropped back to around 4.5%, many landlords saw their monthly payments double, sometimes triple. If you're a landlord who bought with a variable rate mortgage, you went from making a decent return to barely breaking even, or worse, paying out of pocket every month just to keep the property. Then there's tax. Back in 2017, the government started phasing out mortgage interest relief for individual landlords. By 2020, it was gone completely, replaced with a 20% tax credit that doesn't come close to what landlords used to claim. For higher rate taxpayers, this wiped hundreds of pounds off their monthly profit. Add in changes to capital gains tax, increases in stamp duty for second properties, and the removal of multiple dwellings relief. And suddenly, the financial case for being a landlord started looking shaky. But it's not just about money. It's also about control, or rather, the loss of it. The Renters' Rights Bill has been working its way through Parliament all year. It finally cleared the House of Lords in July and is now in its final stages. Royal assent is expected by the end of October, with full implementation likely in early 2026. When it kicks in, everything changes. Section 21, the no-fault eviction notice, disappears completely. Every tenancy becomes rolling and periodic. No more fixed terms. If a tenant stops paying rent, the new eviction process could take 8 months or longer before you see any money or get your property back. For landlords who've relied on Section 21 to regain possession when things go wrong, this feels like flying blind. Then there are the energy efficiency rules looming on the horizon. Right now, rental properties need an EPC rating of E or above. But the government confirmed earlier this year that by 2028, all new tenancies must hit EPC-C. By 2030, every rental property in England needs to meet that standard. The average cost to upgrade a property from EPC-D to C, around £6,200 from EPC E, F or G. You're looking at £13,500. And here's the kicker. Some properties, an estimated 230,000 of them, physically can't reach EPC-C. Solid wall construction, listed buildings, flats in old conversions. They're stuck. Those homes will either need expensive exemptions or they'll have to leave the rental market entirely. For landlords in the Northeast or Wales, where property values are lower, spending £13,500 to upgrade represents 80% of annual rent. In London, it's only 26%. The burden isn't equal. Landlords in cheaper areas are getting hit hardest. On top of all this, there's the general compliance burden. Licensing schemes spreading across more councils, each with their own fees and inspections. New rules on rent discrimination, meaning you can't refuse tenants on benefits or with children. Restrictions on rent bidding. Pet requests that you can't unreasonably refuse. Every new regulation adds cost, adds risk, adds time. For small landlords, the ones with just 1 or 2 properties as a retirement income, it's becoming too much hassle for too little return. And it's not just England. Scotland's been running a real-time experiment in what happens when you pile regulations onto landlords. Back in 2022, during the cost of living crisis, the Scottish Government introduced emergency rent controls. First, a total freeze, then a 3% cap on annual increases, with landlords allowed to apply for up to 6% in exceptional circumstances. The caps ended in April 2024, but transitional measures stayed in place until March 2025. During that time, Scotland saw one of the steepest rent increases anywhere in Europe. By August 2023, rents had jumped almost 12% in a single year. Since 2020, they've climbed by about a third, 3 times faster than before the controls came in. How does that happen? Simple. When landlords can't raise rents on existing tenants, they wait. They let the property sit empty between tenancies, or they sell up entirely. When they do relet, they price it as high as possible because they know they're locked in for the next year. New tenancies became exempt from the caps, so rents on those soared. Meanwhile, the overall number of rental properties in Scotland kept shrinking. Landlords didn't just dislike the caps, they actively exited the market. Even now, with the emergency measures lifted, Scotland's rent growth is running at 6 to 7% annually, among the highest in the UK. And the Scottish Government? They're not backing down. The housing bill currently going through Holyrood proposes permanent rent control areas across Scotland. If your local authority designates an area, rent increases could be capped at CPI plus 1%, with a maximum rise of 6% per year. Some landlords are already planning their next exit. So who's actually buying all these properties landlords are selling? That's where things get interesting. Around 2/3 of former rental properties are being bought by first-time buyers. People who've been stuck renting for years, saving up a deposit, finally getting onto the ladder because there's more stock available, and, ironically, because landlords are selling. First-time buyers now make up 49% of all property purchases in England, one of the highest proportions ever recorded. In some areas, like Manchester, it's 75%. The government sees this as a win. More people owning homes, fewer people stuck in insecure rentals. But there's a problem. When a rental property gets sold to an owner-occupier, it doesn't just change hands. It changes how it's used. Rental properties tend to be occupied more densely. A 3-bedroom house might have 3 or 4 adults sharing, each paying rent. When that same house gets bought by a family, it's one household. Fewer people housed overall. Plus, rental stock often includes smaller flats, HMOs, properties converted for multiple tenants. Owner-occupiers don't tend to buy those. They want family homes with gardens. So the rental stock that's disappearing isn't being replaced like for like. The market's losing exactly the kind of affordable, dense housing that's needed most. Only about 3% of sold rental properties are being bought by other landlords. That's tiny, and it makes sense. If you're a landlord looking at the current landscape, why would you buy now? High mortgage rates, tightening regulations, energy upgrade costs, the threat of more rent controls. Unless you're a professional operator with deep pockets and a long-term plan, it doesn't add up. The landlords who are buying tend to be the big ones: institutional investors, build-to-rent developers. These are companies with portfolios in the hundreds or thousands. They have access to cheaper finance. They can afford to employ full-time compliance teams. They're building new, energy-efficient developments that already meet EPCC standards, so they're future-proofed. Build-to-rent has been one of the fastest-growing segments of the UK rental market. These aren't your traditional buy-to-let landlords. They're corporate entities offering longer tenancies, on-site management, amenities like gyms and co-working spaces. For tenants, it can mean more stability and professionalism. For the market, it means consolidation. Fewer small landlords, more corporate control. Whether that's good or bad depends on who you ask, but it's definitely a shift in how the rental market operates. So what does all this mean for the future? Let's start with the next 6 to 12 months. Landlords who are sitting on the fence, waiting to see what the Renters' Rights Bill would actually look like, now have their answer. Royal assent is coming in weeks. Implementation follows in early 2026. That's going to trigger another wave of sales. Some landlords will decide the new rules are workable. Others will cut their losses before Section 21 disappears entirely. Expect listings of former rental properties to stay high through the winter and into next spring. Rents, meanwhile, aren't going to fall. Supply is still too tight. Every property that leaves the rental market makes the shortage worse. Even though rent growth has slowed a bit recently, Zoopla's predicting around 3% increases for 2025. In some areas, especially outside London, it could be higher. Demand isn't going anywhere. The UK population is still growing. Mortgage affordability is still stretched for many people. Renting isn't a choice for millions, it's the only option. Longer term, we're looking at a rental market that's structurally different from what it was 5 or 10 years ago. Small landlords, the ones with 1 or 2 properties, are going to keep leaving. They're being replaced by institutional investors and build-to-rent schemes. That means more professional management, but also less flexibility. Corporate landlords follow corporate policies. There's less room for negotiation, less personal connection. Rent controls might sound appealing to tenants, but Scotland's shown us what happens. When you cap what landlords can charge, they either stop renting or they price new tenancies sky high to compensate. Supply drops and rents go up. It's the opposite of what the policy intended. England hasn't gone down that road yet, but the pressure's building. If rents keep climbing, if more tenants struggle to pay, calls for rent caps will get louder. And if that happens, expect even more landlords to exit. EPC requirements are going to reshape the market too. By 2030, every rental property needs to be EPCC. That's only 5 years away. Landlords who haven't started planning for it are running out of time. Some will upgrade and stay in the game. Others, especially those with older, harder to improve properties, will sell. The properties that can't be upgraded, those 230,000 homes that physically can't reach EPCC, will either need exemptions or they'll disappear from the rental market. That's another chunk of supply gone. The only real solution to this mess is building more homes. Not just any homes. Rental homes, affordable homes, homes where people actually want to live. But house building in the UK has been stuck for years. Planning rules, lack of skilled workers, rising material costs. It's all slowing things down. Build to rent is growing, but not fast enough to replace what's being lost. And traditional small landlords, the ones who used to provide the bulk of rental housing, aren't coming back. The economics have changed. The regulations have changed. For many of them, it's just not worth it anymore. Here's the thing, nobody's really saying out loud. We're watching the UK rental market go through a transformation that's going to define housing for the next generation. Landlords leaving isn't a blip. It's a trend, and every time a rental property gets sold to an owner-occupier, it might be good news for one family, but it's bad news for the dozens of people competing for what's left. Rents will keep climbing until supply catches up with demand. But supply isn't catching up. It's falling further behind. The big question is whether the government will recognise this in time. Policies that look good on paper, like banning no-fault evictions or capping rent increases, can backfire if they push more landlords out of the market. And once they're gone, they're not coming back. For tenants, the next few years are going to be tough. More competition, higher rents, fewer choices. For landlords still in the game, it's about staying compliant, planning ahead, and making sure the numbers still work. And for anyone thinking about becoming a landlord, you'd better be sure you know what you're getting into, because the rental market of 2025 is nothing like the rental market of 2015. The rules have changed, the economics have changed, and the players have changed too. So that's where we are. Landlords selling up in record numbers, rental supply hitting all-time lows, rents climbing despite every effort to control them, and a future that looks very different from the past. Whether that future is better or worse depends on who you are and where you're standing. But one thing's certain, the rental market as we knew it is disappearing, and what replaces it is going to shape how millions of people live for decades to come. If you found this useful, make sure you're subscribed so you catch the next one, because this story's far from over. Nearly £800 vanished from the average UK home price in a single month. September's figures just dropped, and what they're revealing goes far beyond a simple dip in property values. This could be the first real crack in a market that's been defying gravity for years, and the ripple effects are already starting to show in ways most people haven't noticed yet. Whether you own, rent, or are trying to get on the ladder, what's happening right now will directly impact your financial future. Before we dive in, make sure to hit that like button and subscribe to Property Reporter so you never miss the latest UK housing and property news. Trust me, you'll want to stay ahead of what's coming next. The Halifax Housing Index just reported something that made analysts do a double take. The average UK property value dropped by £794 in September alone. That's a 0.3% decline in just 30 days, and it came completely out of nowhere for most market watchers. What makes this even more bizarre is that prices had actually climbed in August by 0.2%. So we're not seeing a steady trend here. We're seeing the market jerking back and forth like a driver who can't decide which lane to be in. That kind of erratic movement typically signals deeper confusion about economic direction. The annual growth picture tells an equally concerning story. Growth rates tumbled from 2% in August down to just 1.3% by September. We're now looking at average property values sitting around £298,000 across the UK. But here's where it gets interesting. London properties are still commanding an average of £543,000, while first-time buyer homes typically cost around £236,000. These aren't just numbers on a spreadsheet. They represent real purchasing power slipping away and real opportunities potentially opening up, depending on which side of the market you're on. Now, here's the part that should really grab your attention. Nationwide Building Society released their figures for the exact same month, and they told a completely different story. While Halifax saw prices dropping, Nationwide recorded a 0.5% increase. When two of the biggest housing indices in the country can't even agree on whether prices went up or down, something significant is happening beneath the surface. This isn't about methodology differences or regional sampling. This is about a market that's genuinely torn between competing forces, unable to establish clear direction. History shows us that when major indices diverge like this, the market is usually sitting at a turning point. So what's actually driving this chaos? The employment picture has been deteriorating steadily, and that matters more than almost anything else for housing. When people feel uncertain about their jobs or see unemployment creeping upward, buying a home becomes the last thing on their minds. But there's another element creating paralysis right now. The government's autumn budget looms over everything, and nobody wants to make a massive financial commitment without knowing what policy changes might be coming. Buyers are literally sitting on their hands, waiting to see what happens. Sarah Cools from Hargreaves Lansdowne put it bluntly when she noted that uncertainty around the budget is completely putting buyers off. This kind of frozen market rarely stays frozen. It either thaws or it cracks. Mortgage costs are playing a sneaky role in all of this too. The Bank of England paused interest rate increases, which should have provided some stability. Instead, lenders have been quietly raising their margins, rebuilding profitability after a difficult period. So even though the base rate stays put, the actual cost of borrowing keeps creeping higher. Buyers who thought they'd caught a break on rates are discovering their mortgage offers are more expensive than expected. Karen Noakes from Quilter Wealth Management highlighted how inflation remains stubbornly above the bank's 2% target, which keeps pressure on borrowing costs. Lenders are also positioning themselves for potential surprises in the upcoming budget by padding their margins now. First-time buyers, who operate on razor-thin affordability calculations, are getting squeezed the hardest. What we're witnessing is multiple pressure points converging at the exact same moment. Housing supply has increased, putting downward pressure on prices. Buyers are growing more cautious as budget day approaches. Mortgage costs are rising despite stable base rates. Employment data keeps weakening. Any one of these factors alone would create headwinds. All of them together create something potentially much more serious. Tom Bill from Knight Frank assessed the situation with characteristic directness, noting that sellers are finally getting the message that prices face genuine pressure. He expects prices to dip modestly before the year ends roughly flat. But here's the reality behind that prediction. When property experts forecast flat markets, they're often being optimistic to avoid causing panic about steeper declines. The regional breakdown reveals patterns that could predict where this whole situation is heading. London and the South East, traditionally the priciest areas in the country, are showing the weakest growth at just 0.6% and 0.2% respectively. Meanwhile, northern regions like the Northeast and Northwest are still posting solid growth of 4.8% and 3.9%. This north-south divide isn't random. It reflects where economic pressure hits first and hardest. London's property market has historically acted as an early warning system for the rest of Britain. When the capital's prices start struggling, it usually indicates broader economic problems that eventually spread outward. The regions still showing growth today could easily be showing declines 6 months from now if London's weakness continues. Different groups of people are experiencing this market shift in radically different ways. Older homeowners who've been planning to downsize are facing a genuinely worrying situation. Many have built retirement strategies around cashing in their property equity at inflated values. Stagnant or falling prices mean those plans need serious revision. The wealth they thought they had might not materialize when they actually need it. First-time buyers, on the other hand, might finally be catching something resembling a break. After years of watching property values climb faster than their savings could grow, a cooling market makes that £236,000 target less of a constantly moving goalpost. But this advantage only becomes real if mortgage rates stay manageable and jobs remain secure. A cooling market doesn't help much if you're unemployed or can't qualify for lending. Current homeowners are experiencing something more psychological but equally important. When property values rise, people feel wealthier even though they haven't actually sold anything. That wealth effect makes them more confident about spending money on other things. When prices stagnate or decline, that feeling reverses sharply. People start cutting back, saving more, spending less. This creates a feedback loop that can amplify economic slowdowns far beyond the property market itself. Consumer confidence affects retail, hospitality, entertainment, and basically every sector that depends on discretionary spending. The government has already announced plans to overhaul the home buying system, which tells you something about their level of concern. Proposed changes include requiring sellers and estate agents to provide much more information up front, reducing the need for expensive searches and surveys that buyers currently fund. They're also considering binding contracts at earlier stages to prevent chain collapses that waste everyone's time and money. These reforms sound positive on the surface, but they're also an admission that the current system is broken and contributing to market dysfunction. When governments start intervening directly in property markets, it's usually because they're worried about broader economic stability. They see problems most people haven't recognized yet. Estate agents on the ground are reporting fascinating dynamics that don't always show up in national statistics. Jonathan Hopper from Garrington Property Finders notes that well-presented homes in desirable locations are still moving quickly when priced realistically. But there's negotiation room now that simply didn't exist before. Amy Reynolds from a major agency confirms that competition remains fierce for the absolute best properties, particularly in areas where available stock is limited. What this reveals is a market splitting into two tiers. Premium properties in excellent locations continue holding their value and attracting multiple buyers. Average properties in decent but unremarkable areas are facing increasing pressure. This kind of bifurcation typically appears before broader price adjustments, as even the premium segment eventually gets tested when economic pressure intensifies. Several factors over the coming months will determine whether September's decline was an anomaly or the opening chapter of something much bigger. The autumn budget announcement stands as the most immediate catalyst. Any policies affecting property ownership, capital gains taxation, or mortgage interest relief could dramatically alter market psychology overnight. One announcement could either restore confidence or accelerate the pullback we're already seeing. Interest rate stability remains absolutely critical for maintaining current demand levels. If the Bank of England determines it needs to raise rates again to combat persistent inflation, the mortgage market will face another shock that pushes additional buyers completely out of the picture. Even a quarter-point increase could be enough to tip marginal buyers from qualified to unqualified. Employment trends will prove equally important in determining market direction. The UK job market has been showing clear signs of cooling, and if unemployment starts rising significantly, housing demand will face sustained pressure regardless of what happens with rates or policy. People don't buy homes when they're worried about losing their jobs. It's that simple. The employment data over the next quarter could be the difference between a soft landing and something considerably harder. So where does all of this actually leave the UK property market? That September price drop might look small when you see it written as 0.3%, but it's happening against a backdrop of multiple warning signals flashing simultaneously. We've got major indices disagreeing on basic direction. We've got buyers increasingly cautious and unwilling to commit. We've got mortgage costs creeping higher despite stable official rates. We've got weakening employment data. We've got massive policy uncertainty heading into the budget. Any one of these factors would be noteworthy. All of them converging at once suggests the market is entering genuinely uncertain territory. The dynamics that supported steady price growth over the past few years are shifting beneath our feet. Whether we see substantial price falls or extended stagnation will depend entirely on how these various pressures play out over the winter months. For anyone considering buying or selling property right now, complacency would be a serious mistake. The market isn't behaving the way it has for the past decade, and old assumptions about perpetual price growth need serious reconsideration. September's decline might indeed be the early warning signal for something much larger than a simple monthly fluctuation. The next few months will be absolutely critical for determining where UK house prices head in 2025. Everyone with any stake in property, whether as an owner, buyer, or investor, needs to be watching these signals closely. The canary might already be showing distress, and ignoring those warning signs could prove costly. Stay informed, stay cautious, and keep watching Property Reporter for the analysis you need to make smart decisions in this shifting market. Right now, across Britain, just over 1 in 10 renters between the ages of 20 and 44 can actually afford to buy a home. If you're single and renting, that number drops below 3%. Think about that for a second. We're not talking about buying a mansion in Kensington. We're talking about a basic starter home, a 2-bedroom flat, somewhere to call your own. For 97% of single renters in their 20s and 30s, that dream is mathematically impossible. And this isn't just a housing problem anymore. What we're watching unfold is an economic time bomb, one that's been ticking for decades, and the countdown is accelerating faster than anyone wants to admit. The cracks are already showing everywhere you look. Families who thought they'd made it, who bought homes during the pandemic when rates were at historic lows, are now facing mortgage renewals that could destroy them financially. Corporate giants are sweeping in, buying entire developments before ordinary buyers even get a chance to view them. An entire generation has been priced out so completely that home ownership has become a privilege reserved for those with wealthy parents or extraordinary luck. And here's what makes this truly dangerous. Every single piece of this puzzle is connected. When one part fails, the whole system shakes. And right now, multiple parts are failing at once. The mortgage shock hit Britain like a freight train, and most people never saw it coming. Back in late 2021, the Bank of England's base rate sat at just 0.1%. Mortgages were cheaper than they'd been in human history. Young couples, first-time buyers, families upgrading, everyone rushed in. Why wouldn't they? A 30-year mortgage at 1.5% felt like free money. Fast forward to today, and that same Bank of England base rate has climbed past 4%. For homeowners who fixed their rates during the pandemic, reality is about to hit hard. Imagine this: you're a family in Reading, both parents working, 2 kids, modest 3-bedroom semi. In 2021, you locked in a 2-year fix at 1.8%. Your monthly payment was £875. Manageable, comfortable even. Now your fix is ending, and the best rate you can find is 5.2%. Overnight, that same mortgage jumps to £1,430 a month. That's an extra £555 every single month, nearly £7,000 a year. Where does that money come from? Do you cut back on food, cancel the kids' activities, stop saving entirely? For thousands of families across Britain, this isn't a hypothetical scenario. It's happening right now. And it's not just about individual pain. Mortgage approvals have been falling short of expectations month after month. Repossessions are creeping upward. The numbers are still relatively low, but they're moving in one direction only: up. The fear isn't just about today. It's about what happens when tens of thousands of families hit that renewal wall in the next 12 to 18 months. When large numbers of households can't meet repayments, banks start to strain. When banks strain, the entire financial system feels it. We've seen this before. It never ends well. But here's where it gets even darker. While ordinary families struggle to hold onto their homes, a new breed of buyer has entered the market: corporate landlords. We're not talking about small-time buy-to-let investors with a couple of properties. We're talking about banks, pension funds, asset management firms with billions in capital and one singular goal: turn British housing into a permanent income stream. Lloyds Banking Group announced plans to own 50,000 rental homes by 2030. Legal and General is pushing aggressively into build-to-rent, aiming for thousands of units annually. Grainger, one of the UK's largest residential landlords, already manages over 10,000 properties. And lurking in the background are global giants like BlackRock, linked to large-scale acquisitions across the UK housing market. These aren't property enthusiasts. They're financial institutions that see housing the same way they see stocks, bonds, or commodities: as an asset class that generates reliable returns no matter what happens to the economy. And here's the twisted part. They have advantages you and I will never have. They pay cash, so they don't need mortgage approvals. They buy in bulk, entire developments at once, often before those homes ever hit the open market. And here's the real kicker. When you buy 6 or more residential properties in a single transaction, you qualify for lower stamp duty rates, far lower. An individual buying a second home pays 3% on top of standard rates. But corporate buyers purchasing in bulk, they pay a fraction of that. The system is literally rigged to favour billion-pound institutions over working families trying to buy their first home. Why does this matter? Because every home bought by a corporation is one less home available to a family. These properties don't cycle back into the market. They become permanent rental stock, held indefinitely, managed for maximum yield. For investors, it's steady income. For families, it's another barrier, another door slammed shut. And as more homes move from ownership to corporate rental portfolios, the dream of home ownership doesn't just get harder. For millions, it disappears entirely. Let's talk about generation rent, because this is where the true scale of the disaster becomes clear. In 2001, roughly 59% of people aged 25 to 34 owned their own home. It was still achievable. You saved, you sacrificed, you got on the ladder. By 2025, that figure has collapsed to just 29%. Home ownership among young adults has been cut in half in just over 2 decades. Half. This isn't a temporary blip, it's a structural collapse. And it gets worse. Only 8% of non-homeowners in that same age group have enough savings for even a 10% deposit. Not a full 20% deposit, just 10%. Nearly half, 48% to be exact, have less than £1,000 in the bank. How do you save for a deposit when average UK house prices sit around £271,000, requiring £27,000 just to get started, while your rent takes half your income and inflation eats the rest? The answer for most people is simple. You don't, unless you have help. Over 64% of first-time buyers in 2024 relied on the bank of mum and dad. That's up from just 27% a decade ago. If your parents don't have money, if they can't remortgage their home to help you, if there's no inheritance coming, you're out of luck. Home ownership in Britain has become a hereditary privilege. If your parents own, maybe you will too. If they don't, you probably never will. This isn't capitalism. It's a new feudalism dressed up in modern language, and this matters beyond individual dreams. When an entire generation can't build equity, can't invest in property, can't access the wealth-building mechanisms their parents took for granted, the economic consequences ripple outward. It delays family formation, weakens communities, kills entrepreneurship. How do you start a business when you're spending 60% of your income on rent with zero security? How do you plan for retirement when you'll still be renting at 70? The social contract that held Britain together for decades, work hard, save, buy a home, build a life, has been shattered. And nobody in power seems willing to admit it. So how did we get here? Because this didn't happen by accident. This was built, piece by piece, policy by policy, over decades. It started in the 1980s with Right to Buy. Margaret Thatcher's government sold off millions of council homes, promising a property-owning democracy. And for those who bought, it was transformative. But here's what didn't happen. Those homes were never replaced. Local authorities weren't allowed to use the proceeds to build new social housing. The supply of affordable homes collapsed overnight. In the 1970s, councils built over 120,000 homes a year. By the mid-1990s, that number had dropped to just 1,400. 1,400 homes in a country of 60 million people. Then came New Labour in the late 90s and early 2000s. Instead of rebuilding social housing, they doubled down on financialisation. Buy-to-let mortgages exploded, encouraged by tax breaks and easy credit. Homes stopped being places to live and became speculative investments. Prices rose far faster than wages, but nobody cared because rising prices made everyone feel wealthier. Until it all came crashing down in 2008. After the financial crisis, you'd think we'd have learned. Instead, austerity cut public spending to the bone. House building stalled. Governments introduced schemes like Help to Buy, which propped up demand without increasing supply, pushing prices even higher. And now, in 2025, we're living with the consequences. The stamp duty threshold is dropping from £425,000 to £300,000 in April, making it even harder for buyers. Help to Buy has ended with no proper replacement. Planning approvals are at their lowest in over a decade. The government promises 300,000 new homes every year, but in 2024, only 238,000 were delivered. Every single policy lever seems designed to make the problem worse, not better. And it's not just buyers who are suffering. Landlords are fleeing the market in droves, and that's creating a whole new crisis. 1 in 4 landlords say they're planning to sell up in 2025. Buy-to-let mortgage demand hit its lowest January level in 5 years. Why? Because being a landlord has stopped being profitable. Interest rates have soared. Mortgage costs have doubled or tripled. Regulations have tightened. Energy performance standards now require expensive upgrades. Tax relief on mortgage interest has been slashed. Section 24 tax changes mean higher-rate taxpayers are hammered. For small landlords, especially those with just 1 or 2 properties, the numbers don't work anymore. So they're selling. And when they sell, tenants get evicted. Rental supply shrinks. And here's the cruel irony. Fewer rental properties means higher rents. Rents have jumped 8.7% year on year, the fastest pace in decades. Tenants already struggling to save for a deposit now face even higher rents, making it impossible to save anything. It's a vicious cycle, and it's accelerating. The same families being priced out of ownership are now being squeezed even harder in the rental market. There's no escape route anymore. This is why Britain's housing market isn't just broken. It's a systemic risk, a time bomb ticking down, and the fuse is shorter than most people realise. Housing isn't just bricks and mortar. It represents the single largest chunk of household wealth in the UK. For millions of families, their home is their retirement plan, their safety net, their legacy. When house prices rise, people feel wealthier. They borrow more, spend more, the economy hums along. But when prices fall, the opposite happens. Wealth evaporates, spending contracts, confidence collapses. Some analysts are now predicting potential price drops of up to 40% in certain scenarios. That would wipe out 15 years of gains overnight. If prices fall even 20%, which is entirely plausible given current conditions, the consequences would be catastrophic. Billions of pounds in household wealth would vanish. Homeowners would be trapped in negative equity, unable to move or remortgage. Banks holding trillions in mortgage debt would face serious strain. Pension funds heavily invested in property would take massive hits, threatening retirement security for millions. But here's the impossible dilemma facing policymakers. If they let prices fall, it triggers financial chaos. But if they prop prices up, an entire generation stays locked out forever. There's no good option anymore. Every path leads to pain, just for different people. Support homeowners too much, and renters revolt. Do nothing, and a crash could spiral into recession. Try to boost supply, and existing homeowners scream about their property values falling. Britain's housing market has become a loaded gun pointed at the economy, and every political party knows it. That's why none of them will tell you the truth, and the crisis isn't uniform. Different regions are showing different symptoms, but they all point to the same underlying disease. London prices fell 2.6% in August alone, taking the annual change to negative 1.6%. The capital, once the unstoppable engine of UK house price growth, is cooling fast. Meanwhile, December 2024 saw the first monthly house price drop in 9 months nationally. But up north, rents are soaring past 11% in some cities, creating entirely new pressure zones. Manchester, Leeds, Newcastle, places where housing was once affordable, are now experiencing their own affordability crises. There's no escape anymore. The crisis has gone national. If you can't afford London, you move out. But now, the places you move to are becoming unaffordable too. It's like watching a wildfire spread, consuming everything in its path. And the people making decisions, the politicians, the policymakers, the central bankers, they're all watching it happen, aware of the danger, but seemingly paralysed. Because stopping it would require admitting that the last 40 years of housing policy have been a catastrophic failure. The countdown is already underway. The signs are everywhere if you know where to look. The first time buyer market share fell 10% between January and August 2025. House builders are cutting construction targets by 15 to 20% as demand collapses. UK bond yields are now higher than France, Germany, even Greece. The markets are pricing in fiscal crisis, economic instability, potential breakdown. And all of this is happening while household debt sits at record levels and real wages remain stagnant. Something has to give. When affordability hits extreme levels, when entire generations are locked out, when corporate landlords control more and more of the housing stock, when government finances are stretched to breaking point, systems don't just bend, they snap. History is full of examples. Every empire, every economic system that allowed inequality to widen without limit eventually faced a reckoning. Sometimes it was revolution, sometimes it was collapse, sometimes it was war. But it always came. Britain isn't special. We're not immune to the forces that have toppled societies throughout history. And right now, we're walking the same path. Housing is the canary in the coal mine, the early warning system flashing red. When people can't afford shelter, when families are one paycheck away from homelessness, when the gap between rich and poor resembles the Victorian era, the social fabric starts to tear. And once it starts tearing, it's almost impossible to stitch back together. This isn't just about expensive housing. It's about decades of policy that favoured wealth over work, assets over labour, landlords over tenants, corporations over communities. It's about a financial system that inflates asset prices faster than wages could ever keep pace. It's about a political class that benefited from rising house prices while an entire generation was sacrificed on the altar of property wealth. And it's about a reckoning that's coming whether we're ready for it or not. The question isn't whether something breaks, it's when and who pays the price. Will it be homeowners watching their wealth evaporate in a crash? Will it be renters crushed under ever-rising costs with no hope of escape? Will it be taxpayers forced to bail out banks again? Will it be pensioners seeing their retirement funds collapse? Or will it be everyone, all at once, in a systemic crisis that reshapes Britain's economy for generations? Right now, Britain's housing market is a time bomb. The timer is ticking, the fuse is burning, and every month that passes without fundamental change brings us closer to detonation. The tragedy is that none of this was inevitable. We had choices, we still have choices. But making those choices would require courage, honesty, and a willingness to challenge the interests that have profited from this broken system. And so far, that courage hasn't appeared. So what do you think? Is Britain headed for a crash that will reshape everything? Or will governments and banks do whatever it takes to keep prices propped up, no matter the cost to the next generation? Drop your thoughts in the comments below. I read every single one, and I learn a lot from what you share. The more perspectives we hear, the clearer the picture becomes. And if you want to stay ahead of the spin, if you want the real story behind Britain's property crisis, not just the headlines designed to sell papers, hit that subscribe button. Share this video with anyone who needs to understand what's really happening. Because the more people who see through the noise, the harder it becomes for those in power to ignore what's coming. This is Property Reporter, bringing you the truth about UK housing and property news. Stay informed, stay critical, and I'll see you in the next one.